So what's our agenda for today? Very quickly, we'll have an introduction. And at the end of all the sessions, we'll have the Q&A phase where your questions will be answered. And hopefully we'll demystify some of the things that have been on your minds. To get us off started with the first session, we'll have an introduction where we'll introduce the context and objectives of today's webinar. And then we'll introduce the presenters and then go through the presenters flow. Over to you, Bryce, for context and objectives. Thank you.
Thank you, Thomas. Yes, a very short introduction about CoLead, who we are and what we do. My name is Brice Moureau. I work as an access to finance manager within CoLead. So who is CoLead for those of you who do not know us yet? So CoLead stands for Committee Linking Entrepreneurship, Agriculture and Development. We are a network and we're a toolbox. We're a network of more than 500 members within the horticultural sector. We've been around for the past 50 years, among them 20 years implementing and designing programs for our main donors, being the European Union and the OACPs. Our mission is to facilitate and implement all actions that are directly or indirectly increasing the contribution of the agricultural sector and horticultural sector to the achievement of the Sustainable Development Goals. For this, we rely on our internal team of 80 people gathered across 4 offices, 2 in Europe, 2 in sub-Saharan Africa. And we rely on 1,200 experts that are under framework contract to help our partner beneficiaries that are both from private sector and public sector on pretty much all areas where they would need help on. For example, business, HR, sales, marketing, etc., or more technical areas such as crop protection, plant health, certifications, etc. So this is about CoLead. Now, on the next slides, we will try to understand what we're doing here. Why would we at CoLead try to organize a webinar to demystify the access to finance topic? Well, because we've been working in the horticulture ecosystem for the past 50 years, we observe some problems. One of them is the access to finance. It's a recurring observation that it's extremely difficult for agripreneurs to raise funding and access the finance that they need to develop themselves. And we see that from multiple angles. First of all, we see that when talking to our partner beneficiaries, the agripreneurs, they ask themselves the question, do I need external money? If yes, how much? Where should I go to get this money? How long would it take? Should I go to a bank? Should I go to microfinance? Should I go to an investment fund? It's not clear. Also, once I get the money, what will be my obligation? Will I need to repay? Will I need to give shares? Those are all the questions that most of the time remain unanswered and really slow down the process of accessing this money. Also, when we look at the available opportunities in terms of funding, we realize that very few of them are made for agriculture or horticulture projects. Also, the communication with bankers is always very complicated. So this results in the fact that not so many projects get the funding that they deserve. And this is exactly why we decided to create this webinar, to try to answer those questions of what is access to finance, what does it take to raise funds, where should I go, how should I do it? And hopefully by the end of this webinar, you will have the answers to those questions. We've been very lucky to organize and develop this webinar together with our local partners from AgriScope, and I will let the floor to them to introduce themselves. Over to you, Thomas.
Thank you, Bryce. In African culture, it is bad manners to speak to elders without introducing yourself. My name is Thomas Kimani. I'm from Kenya. I have over 20 years experience, progressive experience in horticulture and investments, where I've worked with SMEs like yourselves in developing their businesses, their small SMEs through entrepreneurship, strategy development, market linkages, startup concept design, and all that. My colleague here, Harry, I'll let him introduce in his own voice. Thank you.
Thank you so much, Thomas. Good afternoon, ladies and gentlemen. My name is Arizona Dongo. My background is in finance and business development. For the past 10 years, have been active in providing enterprise support, market linkage, fundraising for agricultural SMEs in the East African region. Thank you.
Thomas, you're on mute.
Thank you very much, Harry. For those joining us right now, we'll go through the presentation flow so that we can be attuned to what we're going to cover today. As a start, Bryce has given us a very good introduction about what CoLead is. And the question that should be running in your mind is, why attend this webinar as an attendee? Next, we will cover access to finance for your agri project. There are so many things out there, but we need to understand why seek external funding at all. After we understood why we are seeking external funding, we look at a project and its journey towards maturity and how we get investment ready. At this point, we will be asking ourselves, at what maturity stage might you need to seek external funding? As our day gets younger, we will look at sources of funding and what makes you eligible. And our key take-home question is, who should you contact? What product is right for you? And how will you qualify for this product? Then, as we begin to wrap up, we'll begin understanding in depth who these investors are. And we'll be asking ourselves how to prepare before we meet them. We need to have the right tools. We need to have the right language for them. And then we'll take you through the process of accessing finance. There are a few very distinct steps that are generally applicable to any process of accessing finance. We'll take you through this. And from there, we will now come to the common challenges. Every process has common challenges. So we'll begin tackling it as a team to figure out what the typical challenges are and how we can try and access finance. Finally, we will share a few success stories so that we can learn from peers, people like you who have successfully obtained financing. And to kick things off, I'll just start the next session with access to finance. We ask ourselves, what is access to finance? And what are the reasons to seek financing for your project? And to kick us off, the $1 million question, what is access finance and what do you think it is? In our interpretation, we find that access to finance is the ability of a business to successfully tap into financial resources. And get this, at the right time, under the right terms, and the optimum amount. Then we ask ourselves, do all projects need external funding? And the answer to this is a big no. So what are the major considerations before we seek external financing? I'll take this through a table where I'll be looking at this through three lenses of viability, internal resources, and the business environment. And just to start, just to give you a taste of this, when we talk about viability, we talk about, is the project you're thinking about self-sustaining? Have you future-proofed it? If the answer to that is yes, go right ahead. We are ready for external financing. If the answer to that is no, we need to work a bit harder using our internal funds, the profits our business generates, so that we can be ready to make the project viable and we can go for external financing when we're ready with that. I cycle back to the internal resources. What are these? These are resources that your business has generated over time, the profits, the cash flows, all that. So as we are asking ourselves, are we ready for external funding? We say, how are internal resources? Are they adequate for to support the project? If the answer is yes, we can go ahead and access the funding. If the answer is no, we need to work a bit harder as we strengthen our internal resources. Now we move to the business environment. And business environment, in a nutshell, what is that? It is, how is the interest rates out there, especially with all this volatility, with inflation and all that? How are the banks giving us interest rates? If you're thinking of importing, say, equipment, Is my local currency being hammered by the foreign exchange? So if the business environment is okay, we say, go ahead, let's seek external financing. If it is not, it is okay to pull back and wait until the business environment is right. What are the reasons we normally seek financing for agricultural projects? There are two main reasons. They can be broken down into two main categories. And I'll start with the commonest, the operational expenditure. And in brief, this is money used to finance day-to-day operations. We talk about salaries, right? This is an agricultural enterprise. You know how cycles go. We harvested a few months ago. The cash flows are dry. You need to borrow to sustain the employees as we wait for the next harvest. We talk about maybe paying an input. Maybe you're buying fertilizer before your cash flows behave. You talk about employee salaries. The employees need to get paid as you wait for the crop to get to market and all that. You need to transport your goods. Point of note, borrowing for your businesses is not the same as borrowing for, say, bride price and all this. We have to separate the two and keep it strictly for the business. I know it's very tempting. You have money and there's a good girl talking out there. Let's keep it strictly for business. Now we go to the main focus of today, which is capital expenditure, which is the main angle that COLLEAD focuses on. What is this? This is money invested to purchase new assets or upgrade existing ones. For example, you're talking of buying a reefer truck, refrigerated truck for your horticulture business, or you're looking to expand the land you normally cultivate on, or you grow your crops on, or equipment for processing, or even a factory for processing. Those are the main things that we use for capital expenditure. I'll quickly jump to, now that we have understood the reasons for financing, I'll now jump to a third session, which is project maturity and investment readiness. I'll take you through the journey to project maturity and investor readiness. And in this, I'll use an example of a mango company. We call it ABC Mango Limited. Normally in agriculture or in any business, for that thought, there are four main phases that an enterprise goes through in the journey towards maturity. In the case of our Mango Limited, the first thing, ABC Limited has been working on mangoes for a couple of years. And along the way, the owner decides, oh, I think I can make a bit more. That's the idea generating right there. I can make a bit more from selling my mangoes as juice. So what does he do? First of all, he has to write down the ideas and he has to know what to expect from these ideas. Before he embarks deeper into this, he has to research and validate the idea. And how does he do that? Maybe start making the juice at home or in the side of his factory, his main factory, and figure out who the market is. He just wants to get a bit of traction on this. He figures out, is this idea valid? Does it have a market? After doing this for a couple of months or a couple of years, I think he feels he's ready for expansion. And at this point is when he'll be thinking, the mango juice is good. I think I need to increase my capacity to juice the mangoes. So he may, at this juncture is when he may need help from outside for external financing. And this is when now even his documentation needs to be a bit stronger because he needs to communicate his ideas to the outside world, not just internally. He needs to communicate his ideas to the outside world because that's where the money is coming from. So he has to be very formalized at this stage. As the business grows and the sales stabilize and growth trajectory stabilizes, that's where we say the business is at maturity. At this point, he may need financing from outside to help him secure the business, maybe branding, maybe getting to markets which were not within his local area, etc., etc. Now that we have understood what the road maturity entails, we have to get ready for the bride, who is the investor, and what we are calling investor readiness. At this stage, we need to understand the critical factors that will attract this investor to our opportunity. And if you're not looking good, they're not coming for the opportunity. So we formalize our activity, right? Where we have our business registered, we comply with relevant authorities, etc., etc. The licenses, the permits. You're dealing with food, you need permits. You need to look legit. After that, this person needs to feel comfortable that his money is in good hands. And that's why we institute strong, sound internal governance structures. This is a strong team, essentially. And without underemphasizing, all this requires documentation, the audit and management accounts, the latest business plans available. Historical records have to be meticulous because you have to speak to that business. And we have to look the future with realistic financial projections. Let me emphasize that again. The historical records, they play a fundamental role in communicating with the external stakeholders and convincing them to provide the support required. Now we move on to the next session. And in this session, we will be looking at sources of funding and what would make you eligible for this funding. Keep your questions flowing. We'll deal with them in the Q&A phase. I won't answer them at this point, but I can see the questions flowing. I'll answer them at the end at the Q&A phase. Thank you. Now, when we talk about sources of funding, I'll start with talking about the common sources of funding. We look at funding using maybe three main silos. We talk of debt. What is debt? Debt is an arrangement where a lender provides money to a borrower, you who is the borrower, and you agree to pay this money within a certain amount of time with interest. We go back to a mango company, needs 8,000 to now buy the equipment, and he goes to maybe a bank, a microfinance institution, or a SACCO. The second silo we look at is equity. Equity is where people come and purchase shares or ownership within the business, right? When the investor buys equity into your company, they become shareholders, which means they also hold a portion of the company, which includes decision making. But the good thing with debt equity is that it is normally patient capital. And who gives us equity? We get it from private equity funds, private individual investors, and impact investment funds. The last silo, which seems to be the most attractive, but the hardest nut to crack, is grants. This one is financial support without the expectation of repayment. Although these days they have changed their repayable grants, but that's another story for another day. So grants are the most attractive, but they're the hardest to get because you have to comply with what the grant maker is looking for. Normally something to do good. Who provides grants? Governments. If your government is good, they provide grants. Even if it's not good, they still provide grants. Let me retract that a bit. We talk about USAID, UK Aid, foundations such as MasterCard Foundation, and then development agencies such as GIZ. All these provide grants. We'll dig deeper into the sources of funding and eligibility by looking at the sources and products for agricultural projects. The first source of funding, which many people overlook, is friends and family. Some people call it the triple Fs, but I won't say what the other F is for at this moment. So who's the main target for this? Who provides this? This comes from close people willing to support your business. It can be friends, it can be your parents, it can be your spouse, siblings, relatives, friends, the whole list. Typically, they give you support from 1 day to 5 years. And their support comes in various ways. It can be in form of cash. It can be in form of assets, where somebody gives you their assets to work with, or collateral. Maybe you need a loan from a financier and they take you and they give you their piece of land or something to hold as collateral. And most importantly, they give you their time. We normally overlook that aspect of time. The second very important sources of funding is the internal sources. I know we had talked about internal sources before, but now we're getting a bit deeper into this. Who supplies you the internal sources? We start with the suppliers, buyers, and shareholders, and I'll dig deeper into each very quickly without digressing. So it depends with the arrangement, the typical period. And how do creditors finance your business? They finance your business by giving you credit terms. If you're a good payer, pay after 30 days, pay after 60 days. How do buyers finance your business? If you're really good in supplying a quality product and maybe there's high demand, your buyer can even prepay for the product and you use his money to prepare the orders. So that's how they prepay for the product. Shareholders, you're one of the shareholders and you can invite more shareholders in it. So that's how shareholders finance a business. And I'll move more into now the commercial side of money, starting with the credit, what we normally call the SACCOs. The target of this is members of the SACCO, and their products normally run from 1 month to 3 years. That's at least in our region in East Africa. Interests range from a low of 12%, that is 1% per month, to as high as 30. And what do they cover? Asset financing, and you can see the list there. An example of SACCOs so that you can tie in better with this. TRA SACCO in Tanzania, Ukulima SACCO in Kenya, ADMAC SACCO in Malawi, Coopitol SACCO in Nigeria, or North End SACCO in Ghana. We're getting hotter in funding now. We're getting to commercial banks. Who are these? You know them. The ABSAs, the Equities, Access Bank, Bank of Africa, Zenith Bank. Those are the people we're referring to as the commercial banks. Normally, they target the bankable businesses, and that's when our documentation becomes very important. The good thing with commercial banks is that they're normally regulated by the central bank in the domicile they operate in. If they operate in Kenya, they are regulated by Central Bank of Kenya, etc., etc. Their typical period ranges from 1 year, 1 day to 5 years in many cases. And what do they cover? Asset financing loans, working capital loans. They have a whole list, which I won't get to the bottom of at this moment because of the limitations of time we have right now. Very closely related to commercial banks are the microfinance institutions. And especially in our part of the world, these are set up to serve marginalized groups and businesses to access finance. Again, very similar to banks, they give between 1 month to 12 months of credit. But their rates are slightly higher than banks because of the risk perception, 20 to 40. And an example of this is Kenya Women Finance Trust in Kenya, FinCorp in Malawi, APA Microfinance in Ghana, Finca in Tanzania, AB Microfinance in Nigeria. The last group I'd like to touch on are the impact financiers. This is a very, very interesting group of financiers. Why? They target companies with a positive social and environmental impact. I won't mention all the different sectors they jump into, but their bottom line is impact. They want to help the people who will make an impact in things they support. Their interest rates are quite reasonable, between 8 to 15%. And even what they finance is quite unique. Like look at financing, pre-marketing financing. You remember we spoke about validating ideas. Maybe they can come in at that point and do pre-market financing if your idea is really brilliant. Who are an example of this? We talk about MasterCard Foundation. In East Africa, we have East African Agriculture. We have FCA, we have Shell Foundation, we have Africa Development Bank, and the list goes on. It's not exhaustive at this moment. As I wrap up, I will jump on to what makes us eligible to be funded by all these groups we've spoken about. And because time is not on our side, I will focus on 2 main groups here. I will focus on the commercial banks and the impact funders. So for example, commercial banks will look for collateral. as important. And what is collateral? This is an asset you give to the borrower to be held in security by the funder. The next thing they look at is credit rating. Where available, there are all these credit rating agencies which have been formed, and banks normally refer to these credit agencies to find out whether the person who's receiving this credit is worthy of the credit. The third thing is prove ability to repay. And we go back to where we spoke about the records, historical records, right? The financial records and projections have to support your repayments. Your history has to kind of support your repayments. They study your habits. Banks are very good at that. They look at your proven ability to repay. If they feel that they are still going to be underwater after giving you the money, forget about them. The other thing that these funders look for is formal structures. Currently in East African market, and at least in Kenya, we are moving away from formalized businesses as a basis for being lent. But this is still a very important criteria for the impact funders who many times come from outside the region and would like to work with a formal entity which has all the right structures. Documentation. I spoke about documentation earlier, and I won't stop talking about documentation. Do you have all the requisite documentations that speak to the funder? Right? My colleague will come and speak more on this as we move along. The documentation that speaks to the funder. Different documents, different funders. Governance structures. Again, we spoke earlier about, is the financials money in safe hands? So the commercial banks and impact funders will look at your governance structures of your organizations. You imagine giving your brother money and your brother, is maybe a drunkard. Would you give him money? You give to the brother who you think is responsible and will make good use of the money. That's the same thinking behind this. Social impact is essentially important for the impact funders. Is there a social good that your project is going to do? For example, our mango processor, he wants to aggregate mangoes and maybe he doesn't have enough resources to put up an aggregation center. This is where the impact funders may come in and help him put together the aggregation center because it's good of creating employment within the community. With those few remarks, I will hand over to my colleague, Harrison, to take us over. Thank you.
Thank you so much, Thomas, for that wonderful presentation. I will now take us through the remaining segment of this webinar. So under this particular second half of the webinar, we are going to look at the basic requirements you need to access finance. After that, we are going to check into the process of accessing finance itself, and then move into the challenges that we are likely to face in our quest towards accessing agricultural financing, and conclude the segment by looking at success stories of agripreneurs who manage to raise financing for their ventures. Let's jump right into it. So to understand the basic requirements that you need to access financing, we are going to divide this topic into 4 distinct segments. In the first segment, we are going to look at the general documentation that you need to provide to the financier, depending on the financier that you've decided to approach. Secondly, we are going to narrow down from the general documentation and look at key vital documents that you need to have, one of them being a business plan. In a business plan, we're going to look at what the business plan basically is and the content it needs to contain. Thirdly, we look at the financial plan by looking at what a financial plan is and its requisite content. As we conclude, we are going to ask ourselves fundamental questions and put ourselves in the shoes of the financier and ask yourself, if you are the financier, what must entrepreneurs seeking financing from you have? And also, what is it that is basically nice to have that will make you comfortable to finance their ventures? As an entrepreneur, when seeking financing, depending on the financier you have approached, you'll be asked to provide a list of documentation. This list of documentations will vary based on the financier of choice you've decided to approach. For instance, what you're going to provide for microfinance institutions will be so different from what you're going to provide to impact financials. To understand these basic documents, we are going to look at 6 distinct categories under which most of the document basically normally is asked for can fall under. The first category of documentation we have are legal and compliance documentation. These are documents that basically speak to the formalization of your business. Do you have identification documents, both for yourself as the director of the company and also for your company? Do you have certificates of incorporations? Do you have business permits? Is your business licensed to operate? Those are legal and compliance documentation that you must provide. Second category of these documentations are corporate governance documentations. These are documents that speak to the structures that you have internally for your company. Do you have policies in your organization? Do you have requisite procedures to follow in a particular organization? The third category of documents are those that speak to the financial. They tell the financial the plan you have for the money you are asking for. Should they disburse the money to you? This includes documents such as, do you have a business plan? Do you have a financial plan put in place? The fourth category of documents that you must provide, these are financial documentations. These are documents that speak to the financial performance of your organization and of your business. They include documents such as audited accounts, financial projections, management accounts, the list of creditors and your list of debtors. These documents will enable the financial to know how your company has been performing financially in the past, how it is performing currently, and how it is projected to perform in the future. The fifth category of documents that you will provide as an entrepreneur are those documents that make the financial feel safe, that the money they're lending to you is in safe hands and will be repaid. And if you do not repay, they have recourse to fall back to. These are documents such as documents on security or the collateral that you are providing to cover the debt you are seeking. But not all financials will look for this. Some will ask for collateral, while others are not going to ask you for the collateral. Additionally, another document in that category are guarantors. Guarantors forms. These are basically normally asked by those financials where you have to be a member, for instance, savings and credit cooperatives, before you are lent money. And then the last category of documentation that you will definitely be asked for, this is basically when you approach impact financials, are impact assessment reports. They are going to ask themselves, does your business have a social impact? And do you have those social impact reports? Does your business have positive environmental impacts? So as I said before, depending on the financial you have approached, you are going to be asked for all these documents or some of the documents. Let's look at a case of a commercial banks. Commercial banks will ask you for all these documents with the exception of social impact reports. On the other hand, impact financials will ask for the same document that commercial banks will ask you for, with the exemptions of, let's say, collateral documents. And in addition to what they are going to ask for, they'll also include impact assessment reports. After looking at the general documents you're supposed to provide to the financial you have approached, we narrow down to basic documentation. These are crucial documents that regardless of who you are approaching, you will definitely be asked for them. The first of such category of documents is a business plan. So what is a business plan? A business plan is basically a document that speaks to both the financial and you as the owner of the business. This is a document that will highlight the plans that you have as the owner of the business, the goals you have, and the timeline for achieving the goals that you've set for yourselves. Because of the vital nature of a business plan in a business, when preparing it, you need to ensure you've done careful research, analyze all the data available, and involve a high level of strategic thinking so that you come up with a very complete, mature, and well-knitted document. And contrary to popular belief that a business plan is basically a tool that is used to secure funding, it is a document that is also important and can be used as a reference material for making informed internal business decisions. So after seeing how crucial this document is, we move and look into what it should basically contain. What are its content? The first component of this particular document is the executive summary. So business plans by nature are bulky documents, and they are being presented to people who receive a lot of them and therefore do not have the time to go through all the pages of a business plan. So the executive summary is the most important facet of your business plan. In a maximum of 1 to 2 pages, it is the elevator pitch that should attract the interest of the reader towards going deeper and reading the entire content of that particular business plan. It should contain a brief background of your company, the market opportunity you need to exploit, the bios of the management team, the competitive advantage that you have as a business over other players already existing in the same field, the financial highlights of that particular business. How have you been performing in the past? How much money do you require? And if should you be given this money, what are you going to deploy the money to do? And what are the projected results that you're going to receive after deploying this particular financial resource that you've obtained from the financial. The second segment for business plan is the business description and the structure. This will look into explaining to the reader, who is the financial in this case, why you are in business and why you are selling what you intend to sell in terms of your agricultural project. And it is this particular segment why you need to speak more about the past of your business so that they really have the backstory of where you have been as a business person. For instance, you've been selling fresh mangoes in the market, and you are now writing a business plan to move into selling fresh juices in the market. They need to see how you've been performing with the fresh mangoes and what makes you think that going into the mango juice business is going to be viable for you and good for you as a business. We move into the third segment of the business plan, which is market research and strategic segment. This particular chapter of the business plan, we look at the market analysis. Have you done your market research? Is there demand for the agricultural projects that you want to venture into? And are there people already in that market? These are your competitors. And what are you going to do to ensure that at least you attract some of their market share? What are the marketing strategies you are going to put in place? And what are the deadlines for you to achieve, let's say, the market share that you are projecting to have? The fourth important segment of our business plan is the management and personnel segment. This particular segment will look at the bio of the management team. As a financier, you have approached me. You want me to lend you, for instance, $8,000 to go and import a mango juicer, an industrial scale mango juicer, to start processing mango juice. I'll ask myself, who is the team behind this wonderful idea? Do they have the experience? And does the experience they have correlate with the targets and the work that this business is doing? If I see that as a financial, I'll be comfortable to provide you the money. And the last segment of a business plan is the financial information chapter. This is where now you present your financial data. How has your business been performing? How much money do you require as a business? And if this money is provided to you, what are you going to use it to finance? And if you finance this business and it's given to you as you intended to do, and all the other elements the market hold constant, what are you going to achieve in terms of performance? Now, the projections that you're going to achieve in terms of these results. Another crucial document that you're going to look into is a financial plan. Just as the business plan, financials will always ask you for a financial plan. They want to know whether you are just borrowing money for the sake of borrowing, and because you know you are likely going to qualify for this debt, what financial plans do you have in place? So this is a document that will detail your company's current financial circumstance and the short and long-term monetary goals that you have and the strategies you're going to deploy as a business that will enable you to achieve these crucial goals. So the first vital facet of a financial plan is the financial goals. It will lay the foundation on which the financial plan is going to be based. For instance, as I said, in the mango company, you want to buy an industrial scale mango juicer. You validated your business idea, the demand has gone up, you are now expanding. Now you need to borrow and access funding from external sources. Why do you need this particular juicer? What goal do you have with it? I want it to, so that it can increase my sales from 10% by let's say 10% at the end of the current financial year. That is the goal that you have as a business. The second segment that you have in a financial plan is the income and expense analysis segment. In this particular segment, we look at what comes into the business and also have a detailed breakdown of the expenses that are going to eat into the income you're generating as a business. After doing all this, we move into the third segment of a business, of the financial plan, which is also very, very fundamental. We're looking at the budgeting and the projection section. In this particular segment, we've already seen the amount of money we're generating in terms of revenue. Now, we allocate this revenue, and this, also we can call it income, into the various expense buckets that we have as a business. The utilities you're supposed to pay, the salaries you're supposed to pay, and the retained earnings on which kind of investments can I put this into for a business. And the last segment I'm going to look into under this financial plan is a contingency plan. As human beings, we plan, but you always know that there are other unforeseen occurrences that may face us in the course of conducting our business operations. So we need to plan for these unforeseen events. We need to have an emergency fund. You have a refrigerated truck that has gone to collect mangoes from farmers, and it breaks down along the way or gets an accident along the way, God forbid. You need to have a contingency plan to go and get the mangoes, because you know mangoes are perishable, and you also need to honor your agreements that you have with the smallholder farmers to uptake their mangoes. If you have any questions, you can continue sending them under the Q&A section, and this slide will be provided where you're going to read the other segments, also very crucial, of a financial plan. After looking at the basic requirements of the financial plan and of you accessing funding as an agricultural entrepreneur, now we move into the last segment of this particular chapter, where we look at what you must have as an entrepreneur for you to access funding and those things that are basically nice to have. And to do this, you are going to adopt the perspective of a financier. Assume you are the financier and people are approaching you for funding. Won't you feel comfortable if the business approaching you as a quality management team with bios that they show that they are much more experienced? Won't you feel comfortable lending to such a business? Secondly, as a financier, won't you feel comfortable lending to a business that has a track record, has been existing for the past 2 to 3 years and has shown a history of performance? Thirdly, as a financier, won't you feel that comfortable you are lending to a business that is viable? Through going through their business plan and financial plan, you see that this is an idea from the past records and how they're projecting to perform in the future. If I finance, it is going to work out. And lastly, as a financier, won't you feel that if the business is tax compliant, if the business has got all the required permits, and if the business and both of its directors have positive credit rating, they are likely to repay the debt that you are going to advance them. On the other hand, we have things that are basically nice to have. They are not going to hinder you from accessing financing, but they are going to increase the financiers' confidence in providing you with the resources you require. For instance, collateral to cover the loan as a financier. If you come to me, you want $100,000 and come with the collateral that in the case that there is business uncertainty and I default, kindly repossess my vehicle or my land and recover your money. I'll be more than grateful to finance you. As a financier, if you come to me with a business that is certified, you have all the requisite certifications, I will more than likely finance you because I know, okay, there's no day the government is going to close down this business because of failure to comply. As an impact financier, if you approach me with a business that has got a tremendous positive environmental impact, I will gladly rush into financing such a business. And lastly, as an impact financier, if you provide me a business plan and a business idea that I see that is going to benefit smallholder farmers down the stream, increase the number of farmers who are harvesting mangoes from 100 to 500, I will gladly look into financing the business. So the document that you must have, these are things that if you fail to have them as a business, definitely you are not going to get financed. On the other side, the things that are basically nice to have, these ones will just make the financier more comfortable and feel safe that the money they're giving you is in secure hands. After looking at this basic documentation you need to provide, we now move and look into the process of accessing the financing itself. Under this particular segment, we look into the step-by-step journey you are going to follow as an entrepreneur to access this agricultural funding. After looking at the journey, we are going to look at the time, the factor that will determine the time it takes for you to access funding, and conclude by looking at the factors that are basically good practices that will motivate financiers to finance your business. Accessing financing is a journey and not an event. This means that there is going to be time lapse from the time you identify that you have a financial need to the time that you actually receive the funding itself. To better understand this journey, we are going to look at the 5 major steps that every entrepreneur normally goes through as they seek to access agricultural financing. The first step is financial needs analysis. We said you have a business plan. You've developed a financial plan. From these documents, you have already identified the need you have. I want to buy an industrial scale mango juicer so that I move from my backyard operation to meet the increasing demand that I have in the market. Now you need external financing. And then ask yourself, you've already proved that you need this particular financing. How much financing do you require? I need $8,000. Of this $8,000, do I need it in terms of debt or in terms of equity? So if you need it in terms of debt, you remember what Thomas presented initially. You look at the business environment. Is this favorable for debt? Look at the internal resources. Can it accommodate the debt? Look at the viability. Because of course, you prove the business is now viable. After answering these vital questions, we now move and identify the right source of funding for your project. We've seen there are several sources of financing, and each of them will ask you for different documentation determining on their needs. Do you want to approach commercial banks? Do I want to approach impact lenders? Do I want to approach SACCOs? Do I want to approach microfinance institutions? Do I want to, any person you want to approach, you need to identify the right source of financing. After identifying the right source of financing, let's get into their product catalog. what product are they providing that is matching what I am producing. I'm a mango farmer. I know the mango cycle will take 2 to 3 years before I start harvesting my mango. I will not go for a loan that I'm supposed to pay back in 1 month. I will not have had revenues coming in. Do they have a product that suits me as a mango farmer? This is what you look for as you identify the right source of financing. What are their interest rates? Do they have an agricultural desk? After answering this question, we now prepare documentation. As we've seen before, documentation. Documentation are the only way you as a business, you are going to communicate to these financials. They are external to your business and convince them that this is a viable business that they can bank on. This is a viable business that they can bank on. Prepare all the requisite documentation, that be ready with them, that when they are provided, you can easily provide them. The next step, the first step, is engaging with the source of financing you've identified. I want to go and get this money from a commercial bank. Now start the engagement. They are going to give you a loan application forms. You are going to fill these loans. They are going to tell you the product that much suits the investment you want to make. And additionally, they are now going to start doing their own due diligence process from the documents you provide. If they ask for a business plan, provide within good time. If they ask for audited accounts, provide within good time. If they ask for management account, provide in good time. So to enable them to do their due diligence process. If you are successful in this stage, you are going to move into the process of now accessing the funding itself. You receive the money, they deploy the money to you, and you use the money to do the project you wanted to implement. And also, importantly, ensure you repay the money. So as you go through this process, as we said initially, the time it takes for me will vary from the time it takes for Thomas, even if you are seeking the same amount of money. Why will this variation be there? Number one, the level of preparedness you have. The more prepared and documented your project is, the easier it is for the financier to do their due diligence and finance your business. If they ask for a business plan and you take 2 weeks to deliver, and they ask person B for a business plan that deliver within the same minute, person B will get money faster than person A because they are prepared. The second factor they look at is the risk of the project. The lower the perceived risk of the project, the easier it is for the financier to finance your project. They know that agriculture is considered risky because of climate perishability and factors of food safety. The only way you can mitigate this is by having document to prove that I've been doing this, it's been working, these are my track record. If you finance me, it's going to do well. These are the projections I have for this. The type of funding you require will also determine the time it will take for you as a business person to get financing. It is much easier for you to get funding. The time it takes for you, for instance, to get funding for loans is much longer than the time it takes for SACCOs and microfinance to finance you. Why? Because you are a member of the SACCO, they have your records, they know you, they'll finance you much faster. The time it takes for equity is much longer than the time it will take for normal debt. Why? Because equity partners will stay in the business for long. They now want to ensure that the business they are riding on, they are banking on, is bankable and is a sure bet. And also grants. Grants will definitely take a much longer time because the grant makers really want to be sure that the person they're giving money, this is not free money, is really going to have the impact they say they're going to have. So they're going to do a lot of due diligence on you. The amount of money you need, the lower the amount, the lower the perceived risk from the financier, and therefore the less time it will take for them to finance you. And lastly, the relationship. I'm a financier. Harrison has come to me to ask for money to improve, to expand his mango or her mango business. And initially he came for a loan. I gave him the loan, financed the loan, and completed paying the money in good time without having problems. He comes for a second loan because we already built a rapport, built a relationship. I'll feel much safe to lend Harrison the money, which means the time it takes for the second loan will be much shorter than the time it took me to grade him for the first loan that he got. As we wrap up that section, we need to plan ahead as business people. Plan your borrowing. Start the borrowing process early, not when you need the money urgently. This will reduce the amount of frustrations you will have with the financials. As we conclude these segments, we look into what is basically nice to do to increase your ability to get financed. Under the first segment, you look at the financial planning and compliance. Under this segment, you, as a business, you need to ensure you have documentation, you have your forecasts. Tell the financier, if you give me this money, these are the results I will achieve. Under this place, do not fail to provide the documentation that the financier requires. Also, don't fail to do regular financial health checkups for your business. Ensure you have positive regular cash flows. We talked of corporate governance before. Ensure you maintain proper corporate governance structures. It will give confidence to the financier and ensure they feel comfortable financing your business. Also, under this particular segment, poorly maintained records and neglecting ethical consideration. Imagine approaching an impact financier to finance your business, yet it pollutes the environment. They are basically going to turn you down even without looking at the business plan you are presenting. So ensure you have proper corporate governance structures. As a business, ensure you are credit worthy. Ensure you have a good credit score, and ensure you have a stellar organizational reputation. Let them know that this business we are financing does not pollute the environment. This business you are financing always pay creditors on time. There's no risk of let's say, collapse of this business. And this particular director, they normally service their loans on time. Under this particular segment, do not default on loan payments, and always ensure you always pay the loans when they fall due. Pay these loans religiously, as it is a key ingredient in ensuring that you get financed next time. Also ensure you maintain positive cash flows, because cash flows that are positive are attractive to the financials. The next segment we jump into are the common challenges you're likely to face as an agricultural entrepreneur in your quest toward accessing financing. So what are some of these challenges? To better understand these segments, we divide the challenges into internal challenges and external challenges. As an entrepreneur, internal challenges, these are those that stem from within your organization. And external challenges, these are those that come from outside your organization, from the market, from the financials themselves. So what are some of these internal challenges that agripreneurs have to deal with? Number one, insufficient level of formality. You are running a mango business. This business is so, you are not formal in this business. You don't have records. It is not certified. You are not tax compliant. It is going to be difficult for you to convince anybody to finance you, because when these documents are going to be asked for, and you've seen they definitely be asked for, you are not going to be able to provide. You have insufficient track record, because as a business person, you are failing to keep your records. So if I asked you, how did you perform in the last quarter? You don't have such kind of data to give me. As a financier, I feel that this business is so risky. The owner himself does not even understand the business. I will not finance this business. So ensure you understand your business and keep proper documentation so that you're able to provide historical and projected performance whenever they are asked for. Inability to provide collateral, as we've seen, collateral ensure that it reduces the risk profile of the debt you are seeking from the financier. If you have collateral, it will smoothen the process and you'll get funding more faster. If you do not have collateral, some financiers who require collateral, like commercial banks, will be a bit hesitant to finance you, especially when you need secured loans. If you have limited ability to prepare the documentation that the financiers require, I told you, as a business person, you are preparing a business plan. The business plan should communicate with the financier you are preparing it for. The business plan you are preparing for a commercial bank will have some slight differentiation with that you are preparing to an impact partner. So you should present to these people the documentation they require in the format they want them in, so that they are able to learn and communicate and relate with the documents you provided them. And lastly, we look at proper corporate governance policies. As a business person, you don't have internal procedures and policies that govern the operations of your business. As a financier, I will not have any confidence to lend you, because I know, what if I lend you the $8,000 and because of relaxed internal controls, employees steal this money? How are you going to repay me as a financier? On the external side, as we say, these are challenges that stem from the market. They are outside your hand. Number one is, lenders normally consider agriculture as too risky, because it's affected by things like climate, where we don't have control over, affected by things like seasonality, perishability. So as a business, the only way to ensure the financials even give you a listening here is to provide documentation. Provide them document. This is how I started. This is how I have moved. And this is how I have performed as a business. It is going to be convincing to them to overlook the risk that they see, as the documents will reduce the risk profile of your business in the eyes of these financiers. Lastly, under the external barriers are that financial products that are not tailored to horticulture. Because of the desire to make Africa food secure, currently several banks in Africa and several financial institutions have an agricultural desk within them. These desks are supposed to develop financial products that are congruent to the production cycles of various common agricultural crops within this particular continent. So when you're approaching a financier, ensure that the facility you are seeking for and the payment period, and even the moratorium, the grace period you are negotiating for, is in line with the financing and the crop cycle you are producing. So don't take a loan that you're supposed to repay within 1 month for a product that will get ready for market in 6 months. As we conclude, we've seen the challenges, and we have to be cognizant of the fact that despite these challenges, it is not impossible to raise money for agricultural financing. As AfriScope, we are fundraisers, and we work throughout East Africa and even Central Africa to raise money for agricultural companies. And we've done this and we're successful at it. This shows that it is possible. We're just going to look at scenarios, 2 case examples of clients we fundraised for in the horticultural value chain. There are several others. In the interest of time, we're just going to look at 2. The first client needed capital expenditure. This is CapEx. This is a client in the horticulture value chain. They are producing baby corns and French beans. They were seeking $150,000 to purchase a processing equipment. We managed to raise for them this money within 10 months from an Impact Financial. Why was this deal closed within a record 10 months time from Impact Financial with a very favorable interest rates? 1, the client had got proper planning of the business cycle. They came to us well in advance of the time they needed money. They had planned their borrowing process. They didn't come to us when they urgently needed the money. So within 10 months, they got their money. Number 2, they had aligned their documentation. You will send the client an email, kindly provide me your last year audited accounts. And within the next 2 minutes, there's a response to that email with the documents attached. All the documentation that were asked for were provided in record time. This also ensured the due diligence process took a shorter time. And lastly, as the fundraisers, together with the client, we approach the right financial. We approach the Impact Financial because this particular client, the business they were doing and the machine they were purchasing was going to increase the uptake of products from farmers. So the fundraiser, the Impact Financial saw that this is going to put more money in the hands of farmers and solve the problem of perishability, because these goods are going to be uptaken from farmers in record time, processed and sold. So the impact on the lives of smallholder farmers was clearly visible. The second case study is a company that needed operational expenditure money. This is a company that provides Irish potatoes. They needed working capital for them to purchase raw material. This is the Irish potatoes. They needed $20,000. We approached a commercial banks, and within 2 months, the company got this particular financing. Why was this deal closed in record time? 1, the business had got good credit rating. Banks are really particular about that. They don't like financing business that had shown a history of defaulting in the past loans they received. The business aligned proper documentation. When they had audited accounts in place, they had management accounts ready, their projections were good, and also they were also realistic. You cannot be selling 10 mangoes today and say that next year after funding, you're going to sell 1 million mangoes. No, the projections were also very realistic. And they also had certifications and all requisite licenses. And lastly, the business had got collateral to effectively secure the debt they were seeking. I hand it back over to my colleague Thomas, who is going to take you through the last segment of this particular presentation.
Thank you, Harry. Can you hear me all?
Yes, we can.
Okay, thank you. Thank you, Harry, for that. Very well organized. And thank you for those who have responded back with a Q&A. And I'll quickly go over the summary of what we've covered today as I open up the floor for the closing remarks. So today, before even we go to what is written on the screen there, 2 main takeaways. First of all, we can't underemphasize records. I know everybody talks about financing, but without records, without speaking to the banks, our work is made very difficult as AfriScope and other people who work in financing. The other thing that works well is planning. If we plan ahead, plan ahead of the crop, see ahead. This is agriculture. Agriculture, a small mistake and you're blown out of the water. So we emphasize planning ahead is very important in our work, in horticulture, in agriculture, in whatever venture. So as a summary, as a closing remark, we introduced what access to finance is, and we talked about CapEx and OpEx. The next, we went through the journey to project maturity and how to get ready for investors. And the importance, we emphasize here, the importance of formalization of your business, governance, and documentation again. I cannot underemphasize documentation. We also went through sources of finance, where we looked at eligibility criteria. And you can kind of see who might work for the product that is out there. Joseph Katigi, we saw your comments. Somebody will get back to you. Basic requirements for access to finance. You saw what was in the checklist, and eventually we went through the process of accessing finance. And you've had the case studies that Harrison shared. And now I'd like to, and the common challenges that somebody goes through. I'd like to introduce Bryce to take us through Colliard section. Thank you.
Yes, thank you, Thomas. So we've booked 30 minutes.
You're on mute, Bryce.
Yeah, I think everyone can hear me now. So we've booked 30 minutes for question and answers. But right before this, let me just remind you what we do at CoLead, because this came up quite a lot in the questions, and rightfully so. So what do we do at CoLead? We do not provide funding. Unfortunately, this is not our mandate. However, we do provide tools and technical assistance to help you, agripreneurs, improve your business skills and thereby be more prepared to access funding. And so we do this in mainly two ways. So we do provide technical assistance, but only upon application. So here on the left-hand side of the slides, you will see that there is a landing page, and feel free to click on it whenever we send the presentation afterwards. Also in the chat, you will see that there is the link. You can apply for support there and present us with your challenges in accessing finance. Accessing finance, however, is not the only area on which CoLead provides support. We do also provide support, as I already mentioned at the beginning of the presentation, on very technical topics such as crop protection, plant health, etc., but also on business skills. And here you see on the right-hand side a list of self-study courses that you can take. They take less than half a day each, and they will serve as a good introduction for whatever topic you're interested in. These are self-study courses. We also have collective courses, but those are upon application. And again, I redirect you towards the link that is provided in the chat. So now that this is all clear, I just want to thank AfriScope team, Harrison, Edna, and Thomas for their explanation and their collaboration. And I will leave the floor to Thomas to answer the questions that we have. And I think we have a good one in the Q&A chat already from Wester. So over.
Okay. Okay, thank you, Bryce. And now we're in the Q&A section. Wester. Harry, will you take the question from Wester? Okay, Harry will take the question from Wester.
Hello, can you hear me? So Wester, you are asking, can you add an example of how long? Can you add an example of how long it will take to use asset financing or procuring a vehicle or a truck? This is usually a product that is less horticulture specific, and then should be easier for banks to provide lending. Thank you. I tend to concur with you. One of the requirements for financial institutions to lend you is the need to have collateral. When you have collateral, they will feel much safe to provide you money. Why? Because they know in the case of default, they are able to cover their risk by repossessing the asset and financing, selling it and getting their money back. Asset financing, the asset itself serves as the collateral. That is why when you want asset financed, the bank will not even ask for collateral because the asset itself guarantees the money you are asking for. So they're just going to ask for a small deposit, and then the asset that you are giving, even if, for example, it's a refrigerated truck, if you fail to perform on the loan, they'll just repossess the vehicle and sell to the next horticultural farmer. So it will take a very short time, or in my experience, in Kenya, 3 months on the higher side, for you to get that particular financing, if it's asset financing. Any other question?
So I had one question, Harrison.
So I'm seeing a question from an anonymous attendee. How does a social impact report look like? Social impact report, this is a report where you basically show the impact financial, what you are doing as a business, how many employments you are creating, what you are doing in terms of mitigating hunger, in terms of nutrition, in terms of the climate, in terms of the environment. So anything good you are doing as a business in terms of conserving the soil. Basically, any good thing that can sell you outside there. That is how a social impact report looks like.
Thank you, Harrison. I had one question. How does access to finance differ for agriculture compared with other sectors, like more classical sectors, maybe? So the question is, as an agripreneur, accessing finance is not easy. What about other sectors? Is it easier for other sectors?
Yeah, I'll take that, Bryce. As accessing financing is easier for other sectors as compared to agricultural ventures. Why? Because as I said before, there are inherent risks that financiers look at when they see agri-entrepreneurs. Number one, you are depending on rain-fed agriculture. Rain-fed agriculture, today it can rain, tomorrow because of climate change and global warming, there are no more rains. Number two, perishability. Most of the products we produce in agriculture are perishable. Mangoes, you cannot keep them for forever. They are going to go bad. So because of perishability, financiers tend to fear. Number three, we have things like food safety. These particular regulations keeps on changing, and financiers are also aware of this. So they are going to see a risk when it comes to financing agriculture. But as I said before, there are several ways of making the financiers look at your particular agricultural project in a more favorable manner. This is through providing documentation. If you provide them a business case and they see that this is where this business started in 2013. It started by selling fresh mangoes. And from doing, let's say, 1 bucket of mangoes, it moves and it's now exporting mangoes from, let's say, Ethiopia into Israel. They are going to see that particular track record, and they're going to see numbers, projections that you have into how you're going to perform into the future. If you diversify and now move from, in addition to fresh mango, start selling mango juices. So that particular record is going to even make it more lucrative for these financials to finance you. So even though there is a basically risk-averse attitude from financials to financing agricultural ventures, documentation in our experience has proved to mitigate that particular risk. If you provide the requisite documentation, and we financed a lot of agricultural ventures, basically through them providing documents. Document even that minute thing, it's going to come in handy when it comes to raising money.
It's great explanation. Thank you, Harrison. There is another question I've read in private message. What are some common mistakes that I, as an applicant, make typically during the finance application process? So let's say I'm in contact with a bank for a loan on some processing equipment, processing machinery that I can order in another country. And I'm discussing with the bank to actually get the loan. What are the common pitfalls or the potential difficulties I might face?
Okay, I'll take that. Some of the common pitfalls that you're likely to face in that particular process, I think we went through some of them. Number one, we look at the 5 C's of credit. Do you have a good character? If the bank start doing their own due diligence and find that you defaulted in a loan previously, they are going to see you as a risky person to lend. We talked about you looking at now the corporate governance structures you have. You want me to give you $80,000 to import this particular machinery. Who is the team? Who are the brains behind this particular business? Do they have the requisite experience? Maybe you have been doing well in mangoes, and now you are going to the bank to finance you to start a business of exporting apples. Yes, you've been in agribusiness, but you now want the bank to finance a different line of business where you have very little experience. So if you go to the bank with such kind of request, they are going to see a mismatch between what you are experienced in and what you have a track record in vis-a-vis what you want them to finance you in. Even though they're in the same value, in the same industry, they are not going to finance you with that. You lack certifications. Yes, you want to export. You say, I want this money to buy more mangoes to export to let's say, Europe. and they ask you, do you have the phytosanitary certifications? Kindly provide some of them. You are not able to provide. Now they're going to ask themselves, how are you going to even export these mangoes without meeting the EU requirements for you to export mango to their continent? So those are the common pitfalls that you are likely to face. Others are so there are so many pitfalls. For instance, they look at the projections that you provided them, and they are unrealistic. You are saying that I've been doing this business for 3 years, and in the 3 years, the maximum you've ever sold is, let's say, $1,000. And you are saying, with this money, I'm going to sell $2 million within a month. They're going to say, okay, how is this possible? So such kind of things are going to make the bank look at such a request with a third eye and say, okay, there is a big risk to this. The entrepreneur is over ambitious, and we don't want to fall into that trap of this becoming a bad loan.
Great, thank you, Harrison. I see there's also a question from Olushola, who's asking, is it possible for you to talk briefly on insurance and guarantee scheme as related to horticulture? Do you have any information on that, or shall we get back to Olushola privately afterwards?
Yeah. Yes, Thomas?
All right, let me take that. Insurance and guarantees, like I said, horticulture has come from a long way, where before it was just there, it was horticulture. But the financial instrument providers are beginning to understand that this is indeed a powerhouse of an industry. I'll speak more of the situation in Kenya, where we have some of these insurance companies have developed things like farm insurance, where they can guarantee equipment, they can guarantee your product against maybe vagaries of weather. So that is, the industry is beginning to take traction. I am not very much aware of the industry in West Africa. Olushula, I'm assuming you're from West Africa. I'm not very conversant with the market in West Africa, but once one side starts happening, it will of course happen on the other side. So it is beginning to happen. When you come to credit guarantees again, this is neither there nor here, but there are some organizations out there, especially the impact funders, which are creating credit guarantees to help you market your product, where they create a credit guarantee to help you import equipment you not normally afford. So all those things are happening in the market, but you have to be very focused on who you speak to, but they indeed exist in the market. Thank you.
Thank you, Thomas. I see another question from Sunday. You are asking, well done, how does a startup that does not have an historical record access financing, knowing that this organization has been running for less than 3 years now and has been managing its employees? What is the chance of this company procuring finance, as it will be launching its project this year? It's possible for startups to access financing. This does not mean that when you don't have documentation, you are completely blocked. We have seed capital. There are several investors who are, we call them, we normally say, they like getting into businesses at the ground floor. If you have a business idea that you come and talk to them and show them that this is viable, I believe in this, they can finance that. And most of these are normally impact financials. With them, they are going to look at your business idea with a different mind. They are going to say, okay, if it is not going to break even in the first 2 or 3 months, or even 3 years, but the farmers from who these products are going to be uptaken from are going to benefit from this. So they are likely to finance, knowing that it's going to break even in the 4th year. Additionally, if you cannot get external financing, we normally tend to overlook internal resources. You as a person, you have your family members, you have friends who you can go into, seek this financing to get proof of concept. As you get proof of concept, you document that proof of concept, which will make it easier for you to get funding. But basically, without documentation, your only recourse will be seed capital financiers, who are mostly impact capital raisers, and also these are people we call angel investors. Some of them who like getting in at the ground floor of the business. I hope that answers your question. see another question here from Amodu Guy. I hope I pronounced that correctly. On the slide of must-have and nice-to-have requirements, considering the post-COVID context and ecosystem where businesses need to be sustainable in order to be more viable, resilient, and successful, could we consider placing the following areas under must-have instead social impact on smallholders and environmental impact? So the main consideration that we took in when classifying the two segments were the people you are approaching. When we look at a social impact and environmental impact, yes, they are nice to have, and they're going to make me as a financier comfortable to finance you. But when I'm a bank and I want business, I will really not look into that much into it. I'm mostly going to care about how much money you are making you as a business, and is that money enough for you to repay the debt I'm advancing you? Or however, on the other hand, when you approach me as an impact investor, as a grant maker, I will be more concerned about resilience. I'll be more concerned about impact on smallholder and environmental impact. Why? Because in my charter, in my mandate, I'm supposed to look at the environment, I'm supposed to look at the smallholder farmers, and I'm supposed to ensure that the money, which is basically taxpayers' money from other jurisdictions, is put to the best possible investment to generate the most impact on the people it's supposed to touch their lives. So that's the only reason why we put it under the nice to have. Because even if you don't have them, there are several other options where you can get funding from, not only impact investors.
Thank you, Harrison. I'm going to take the next one. I see a question from Laura. Good afternoon. Which countries have been targeted for technical assistance and financing? Well, Laura, we are on...
I'm seeing a question from Tapera Mposi. Why don't you establish your company in Zimbabwe also? Oh, that is nice. I hope my managing director is hearing this, Edna. We need to expand to Zimbabwe. We welcome this and we look into that. We started in Kenya, we've expanded into Uganda, we have clients in Tanzania. So we are basically working in the East African region. We are sector agnostic, but and also in Ethiopia. But I don't know, it's by design or by God's grace, we find that most of our clients who seek financing, it's in the agricultural sector. I think most fundraisers tend to ignore it because of generally what we've discussed before you here. But at AfriScope, I think we've hacked this.
Yes, so I'm just going to complete Harrison's answer here. So Harrison was talking for AfriScope being one expert company that we worked with co-leads in the context of this webinar. If I answer this question from co-leads perspective and also syncing this question with Laura's questions on the countries in which we're active. So we at co-leads basically cover the whole ACP region, so Africa, Caribbean, and Pacific, meaning that we are active on pretty much all sub-Saharan Africa countries. In terms of technical assistance for access to finance, we are gradually rolling out our first supports. The best way to get them is to apply for supports at the link that we did provide in the chat, and that will also be in the follow-up email. The process goes this way. You apply for support, there's a questionnaire that you answer. The country supervisor will come back to you with some more questions, and if you tick the box of access to finance interest, you will also have to fill in a specific questionnaire of 2 pages that's very short and asking you to give us information about the maturity of your project, what you have done already, the crop you're growing, if you have a business plan or not, a financial plan or not. And then we will analyze your requests and we will decide on the most adapted supports to bring to you. Depending on your maturity, this could be redirecting you towards a self-study course or a collective course, or even supporting you with having an expert that's going to come and answer your questions and support you in this initiative for a couple of days or more. So the most important point is to apply for support on co-leads application for support landing page so that we can consider your application and your requests, and we will come back to you. Okay, I think we're going to head towards a closure of this webinar, as questions are becoming to be scarce right now. But I really want to thank everyone for their participation to this webinar. I encourage you all to provide some feedback for this presentation, as it's the first webinar we do on access to finance. It's a topic on which at CoLead we've been working for the past 5 years in total, I'd say, and more intensely over the past 2.5, 3 years. We are striving to come up with solutions, concrete solutions, to help our partner beneficiaries to actually overcome this barrier of access to finance, which we believe is a really important one and a crucial one to overcome in order for the sector as a whole to develop. We see too many projects that are really full of potential and that do struggle because of this access to finance topic. So we encourage you to bring feedback. We encourage you to apply for support. We encourage you to read the detail in the slides. We know that this is a lot of content. We had to rush a little bit because we wanted to cover everything in 1 hour. Please feel free to review the recording that will also be sent. And we look forward to continuing supporting you on this topic, but also on other topics that CoLead provides help with. Thank you also to AfriScope, without whom we could not have developed this webinar. They've been of a great support, and I can only recommend them as an expert company to guide you through this bumpy road that is access to finance and also business development. Thank you, Thomas. Thank you, Harrison. Thank you also, Edna, who's in the background here. And from our side, thank you, Waiting, from a CoLead team, for organizing and coordinating this. Thanks, everyone, for your attendance, and very much looking forward to talking again in the next webinar. Thank you. Bye-bye.